All right. Good afternoon, everyone. Thank you all for joining us today for the quarterly investment outlook and market update. I'm Jeff Carbone, managing partner of the Cornerstone Wealth Private Wealth team, joined as always by Cliff Hodge, our partner and chief investment officer. Cliff, great to have you as always.
Likewise, Jeff. Great seeing you. Happy to be here.
Well, Cliff, it's Cliff and my pleasure to provide you all with an update, overview, current financial landscape, what we're seeing, market trends, the indicators. We'll go over all of that as we always do. As we all know, the global economy continues to be dynamic. It's always in that state of flux and change, whether it be the geopolitical, electoral, or the technological advances we've seen so far in 2024, AI, you name it. It's certainly been quite interesting in this first 6 months, and we'll talk more about just the quarter. Understanding those implications on the market, the broader economy, and how making informed investment decisions are always, on top of mind for us. As you know, it's our job is to provide you the confidence and the clarity as the cornerstone of you, our clients' financial lives. We're recording the session today, as we always do. We'll post it to our website, Facebook, YouTube, you name it. We'll put it on the website. It will allow you to share it because you get an email with it as well. You can share it with colleagues, family, friends. Send it along. We'll also, during the session today, we'll be taking some questions if you have some. So feel free in the chat box on the bottom to throw a couple questions in there should you feel the need or have anything on top of mind. All right, well, past quarter, let's talk. We've observed some significant movement in the major indices today. Not so as we start the third quarter, not a great day to start. Markets really moving. I know, Cliff, today we're going to dive deeper into those key drivers of what we've been watching and what we're seeing ahead. Of course, they're going to include, economic growth, inflation, a big part of our GPS roadmap, our investment process. We'll talk about interest rates. Fed meeting coming up in September should be certainly maybe that first rate drop ahead. Earnings, we're in the mix of earnings season. A couple announcements coming out right as we're talking right now, but corporate earnings are in top of mind as we're seeing this week and next week, two biggest times in earnings a quarter. So we'll have some highlights there. Well, we could also talk back. We went from quite a few geopolitical and political developments, from the potential of the assassination attempt of President Trump to President Biden no longer running, and now looks like Kamala Harris, a VP, will be taking the forefront for the Democratic Party. We'll continue to watch those and many others ahead. So let's, our goal today is to really, again, provide that comprehensive understanding, the environment, the conditions. We want to equip you with the education and the insight to navigate and understand the complexities that we're seeing out there. We'll also be addressing the allocations and maybe some adjustments we've been making. I know we've been busy with our bond portfolios and are starting on our equity portfolios as we adjust into the next quarter and ahead. So, Cliff, without further ado, let's start the journey today, and why don't you get us going?
Thanks, Jeff. Thank you for teeing everything up for us today. There's certainly been no shortage of headlines, market moving events, data that we've seen just come pouring through so far in 2024 as we turn the page to August and get ready for back to school. But so far, largely markets have taken things in stride, and we're overall having a pretty nice year. So the Dow Jones Industrial Average, for example, is up 10%. The S&P 500, which, as we all know, has now been dominated by the Mag 7, the 7 mega cap growth tech stocks, up 16. International markets, if we look outside the U.S., are up 8. And bonds have finally started working as well as interest rates have peaked, and we're getting closer and closer to the Fed starting the rate cutting cycle. We've seen rate moves happen in Canada with their central bank. The Bank of England just announced that they're cutting rates. The European Central Bank as well. So the market is currently pricing in the first cut in September, as you mentioned, Jeff. We think that makes a lot of sense. And in response, we've seen bonds. We talk a lot about the Barclays Ag. The Bloomberg Barclays Ag is akin to the S&P 500 for the bond market, is up now almost 2% for the year. So, so far so good. We're hanging in there. But there are some things that we're watching. There are some storm clouds on the horizon, so to say, that have our attention. We'll walk through what those are. And as always, I've got some slides to run through. So let me get those up and running, and we'll get moving here. So today we're really going to focus on three sort of key takeaways, right? First and foremost, the macro data, as we mentioned, has come in strong for the first half of the year. Recent data releases, which we are certainly more focused on, especially anything related to the labor market, anything related to leading economic indicators. We are starting to see those come in and slow down a little bit more than expected. Inflation, great news on the inflation front. We continue to trend lower toward the Fed's 2% target. It's come in quite nicely, and in June we actually saw a little bit of deceleration or deflation. Prices actually came down month over month for the first time since COVID, so that is certainly a welcome sign and is going to give the Fed a little bit more room to maneuver in the with the easing in the rate cutting cycle if the economy does continue to slow down, which is certainly nice to have. From an investment perspective, one of the key takeaways is that stock markets actually don't look all that attractive right now on a go-forward basis, and we'll talk about why. But some of the key issues are valuations. They're very elevated. Earnings expectations are really high as well, and are at odds with the macroeconomic forecasts of a slowdown. And then thirdly, investors have largely pushed their chips in. There's a lot of euphoria still surrounding AI. We're seeing a bit more volatility here over the past couple of weeks. So we're going to be looking to do some repositioning on the equity side. Just do want to clarify that we are still fully invested right now, but we are certainly on watch to take some chips off the table in the stock market in favor of other asset classes, things like bonds, which we've been talking about over the past couple of webinars, and alternative investments as well. One of the key data releases that we're going to be looking out for is the July employment report that comes out tomorrow. That's going to be very important. As we'll talk about, the labor market is really the linchpin for everything macro and markets at this point in the cycle. And we haven't even talked about the election, right? So we have an election to deal with, which is now less than 100 days away. That is certainly going to generate a lot of short-term noise. But as we'll see, and what we looked at in preparing for the call today, is that if you zoom out, right, short-term elections certainly always cause a lot of noise. Who's going to be the president? What's Congress going to look like? What are their priorities? Certainly cause volatility in the short term, but over the long term, which is what we care about, what our clients care about, we have data that actually shows that elections, by and large, are pretty meaningless. So there's a lot to do, a lot to talk about. But let's just start quickly with a view of our dashboard. Still a lot more yellow and red than green. We still believe we are currently late in the cycle. Growth and inflation are slowing. Federal Reserve has not started the easing cycle yet. From a macro perspective, fundamentals were still expensive on equities, as we talked about. Earnings are okay, but the expectations are very high. And then positioning, just certainly nothing there that would get us excited about getting more aggressive from a risk perspective. We'll do a quick review on GDP. On the left-hand side, we're looking at the components. So, I'll draw your attention to the gray bar. That's the consumer. We saw a nice rebound in consumer spending in the second quarter, and GDP actually came in above expectations at 2.8%, quarter over quarter on expectations of 2%. So a nice beat driven by the consumer and driven by inventory, which was, the inventory restocking cycle. You can kind of see the pattern there in yellow. If for a quarter or two, it may contribute to GDP as businesses replenish the inventory that they have on their shelves and sell those down, and that it's kind of a leading and lagging part of the GDP component. But looking on the right-hand side, still growing nicely above the long-term trend after we had that big dip during COVID. Nice rebound. We are still growing above the longer-term trend. So certainly nothing that we've seen in the data that has been realized yet is really all that nerve-wracking. The numbers have certainly been solid. Inflation as well. We've seen really nice trajectory where we peaked out over 9% post-COVID in 2022, and after all of the stimulus that came through the channel. And we are trending down nicely toward that Fed target of 2% inflation. Still have a little bit of work to do, but as I mentioned at the beginning of the call, June was the first negative print that we've seen since COVID. So we would continue to look to see the inflation numbers come in, play nice, so that the Fed is able to ease with ease interest rates. That's what the market is waiting for now, what everyone's waiting for as far as the housing market, housing prices, so on and so forth. So that's largely the story in the first half of the year. If we kind of turn toward more high frequency data and some of the things that we are seeing that is a little bit worrisome for stocks, is that the data that's coming in real time, especially some of this leading data that we talk a lot about and that we track fairly closely, are slowing pretty quickly. So if you look on the left-hand side of this chart, this is the City Economic Surprise Index for various regions. We've got the US, European, the globe, right? So basically what we're looking at here is realized data coming in relative to expectations. So anything below 0 means that the actual data is coming in lower than expected. And that, you're going to see some volatility there, but what's important is that this is typically what we see at the turns, right? As consensus and economists still have a little bit more of a rosy view, surprises start coming in negatively, and then the data turns. That's what we're on watch for right now from a macro perspective. We haven't seen enough to really want to go risk off, but if the trend keeps continuing, that is going to have us looking to want to be more aggressive in taking risk off in the equity markets. The ISM report this morning, Jeff, we talked about market moving data that came out. It was a really bad number, showed contraction broadly across the manufacturing sectors. And the employment report for manufacturing was pretty awful as well. So that's just another example of recent macro data that is now starting to bleed over into the indices, and that's why we saw the weakness today at 10 o'clock. Things just turned. If we look at the right-hand side of this chart, went a little bit too fast there. We look at the right-hand side of this chart. What this is called is the beverage curve, and we won't get too technical on this, but it's important because, as we say, labor market is front and center for us. So what we've been looking at is these red dots. First on the left-hand side is the vacancy rate. So think about job openings, the relationship between job openings and unemployment. And we've been in this scenario really since COVID. All these red dots here. Let me make sure I'm get my right screen. Where we've seen job openings come down, the vacancy rate come down, but it has not had any impact on the unemployment rate. That's fantastic. That means that the labor market is cooling. Inflation can cool without seeing a rise in layoffs and unemployment. That is exactly what we want to see. That's exactly what the Fed wants to see. But now I'll call your attention to this gray dot, June of 2024. And why this is important is because if you look at these green dots, the dark green and the lighter green, This is what the relationship looked like really going back to the global financial crisis. So from 2009 to 2020, you could see the change in slope in this line, that as the vacancy rate came down, so as the labor market continued to cool, we actually saw that inflect into a higher unemployment rate. And we are right near the part of the curve that says, okay, unemployment could start rising. And if we see this happen, that's why tomorrow is going to be really important. That is going to increase the likelihood of a recession, much more so than what the markets, the equity market, the bond market, and so on and so forth are pricing in. And so tomorrow is going to be a big day, and we'll certainly be watching and ready to react to that. And why this is so important is if we kind of take a step back and look at the longer term view, the longer term relationship between the unemployment rate and recession, the recession in the gray bars here on this chart, you can see that going back to the 50s, every time the unemployment rate bottomed and turned higher, we've just really never had any instances where it just starts going sideways and everything is okay. Typically, once the labor market bottoms and starts moving higher, you get that negative feedback loop, right? Where people, layoffs start to happen, spending slows down, that hits corporate profits, which then may cause corporations to get even more aggressive around layoffs, and it's just this negative feedback loop, this vicious cycle. That's what we want to avoid, and that's what we are on watch to try and understand. So as of right now, looking at the chart, we've certainly bottomed. We started moving higher. It has not inflected, but the risk is that the labor market continues to cool, unemployment rate turns higher, and then we go into a recession. That's not what the market's pricing in. The consensus view is that the economy is going to avoid a recession, hit a little bit of a slowdown, a little bit of a soft patch in 24 and 25 before the economy inflects back higher. We unfortunately are not so confident in that view. Why? In a word, history. We are huge fans of market history. This slide is a history lesson. We're going to take a minute just to look at it going back to the 1970s. So there have been, what we're looking at here on the left-hand side are rate hiking cycles. There have been 9 of them since 1970. The 10th starting in March of 2022. So as we can see, 7 out of the 9 of these resulted in a recession. 2 out of the 9, going back to the 70s, were the soft landing, right? That's what the market is hoping for. That's what the equity markets are pricing in. The 2 examples, 1983, 1984. Here, the Fed hiked about 300 basis points. This is right after the double dip in 80 and 81. The other soft landing scenario that people point to as a comp or a comparable for this time period is 1994, 1995. That's the optimistic case as well. Another 300 basis points, no recession. So there's certainly a chance that could happen. Again, how things are priced, we don't think you're getting paid to take on that view. But what was interesting, if you look back at all of these, is that on average, if you take the median, recession started 29 months after the first rate hike. So that's more than 2 years, 2 years and 5 months. This go around, the first rate hike was in March of 2024. I'm sorry, March of 2022, rather. 29 months after March of 2022 just so happens to be August 2024. So to be clear, we're not saying we are in a recession now. We don't think one is starting immediately. We just highlight this to say that the consensus that we're not going to have a recession, that everything is going to be fine, the long and variable lags, we are still inside that window of risk. And so we want to be very mindful of that. We want to plan ahead and be ready to take action as markets evolve and markets change. Really quickly on the right-hand side, we're just looking at what GDP growth was 1 quarter prior to the start of each recession. You have to remember that recessions are never called in real time. They're typically always called after the fact, sometimes up to a year later. So we just point this out to say if you look at what growth was doing the quarter prior, typically there's not this, really long lead time. Recessions can come on suddenly without really a whole lot of notice. And so that's why, as part of our process on the investment side, we do a ton of scenario analysis. We want to plan ahead. We want to have a game plan. If X happens, then we'll respond with Y. If Y happens, we'll respond with Z. And then we rely on these real-time indicators, 30 data points a month, 90 data points a quarter, that feed into our process so that we can act quickly as things evolve and position our clients for whatever the market or the economy may bring. So Jeff, maybe we take a pause there. Covered a lot of ground.
Cliff, as always, you shared a lot of information. There's a lot of detail in those charts, right? I think we could all, as we take a step back on everything you went over, right? We can see inflation while coming down. The bar has been set, right? Doesn't mean food prices or gas or whatever it may be is coming back down to where it was 2020, right? We've set the new bar, or housing, whatever it may be. So inflation, while moderating and not to that 2% target, it's costing us more. The growth, we can, even though it's fairly strong GDP, surprising. But even while you were talking, Cliff, Amazon just announced, and they did not hit. They missed. I didn't get the full, but I just saw they missed, and then they're projecting going forward decline, right? So how can Amazon decline? My wife orders enough, right? I think for all of our families, we order boxes and boxes, but things are slowing. We're starting to see those cracks. You mentioned the labor market. So looking at all of these factors, I mean, the big holdout has been labor, but it's the cracks are starting to show, right? Can we really escape a recession? We all hope we can, but history may not be on that side to avoid a recession. So we're taking everything we can on our side and with the investment team and your team to make sure we, as you put it, if X happens, we go Y. If Y happens, we go Z, right? We make sure that there's a game plan, there's a process. So Cliff, with that, let's start talking about what we've been doing or what we're looking to do from some of the allocation changes or portfolio adjustments we're looking at.
Yeah, absolutely, Jeff. That's a great summary. And so far, most of what we've done in portfolios year to date is really focused on the bond side, right? We came into the year with our interest rate risk or our duration underweight relative to the benchmarks. We're okay taking on some credit risk to generate a little bit more income. And as the markets have evolved, the economy has changed. Some of the major changes have been on the bond side, right? So we have traded our credit risk for interest rate. We want duration because we like the total return opportunity, which we'll talk about here in a moment. We sold off a lot of our high yield exposure, sold off a lot of the corporate exposure as well, taking that underweight in favor of government bonds and things that are high quality, a little more defensive, right, on the fixed income side, and that's been the right move. For equities, we will kind of get into some details here. We've made a couple of tweaks, but we're certainly looking to do more. Especially as we kind of go through the earnings season, as you mentioned, Jeff, this week, next week are big. We've got the employment report tomorrow, but right now, just looking at the investable landscape, right, between equities, fixed income, and alternatives, equities are the one for us that are the least attractive, and for three reasons, right? So first and foremost, valuations are unattractive. We're at 21 times forward earnings. That forward earnings estimate is also very high. So if you look back over 20 years, we're in the 92nd percentile from a valuation perspective. That just means that there's only been 8% of instances that have been more expensive than where we are today. We don't love that. Secondly, expectations for earnings are very lofty. We're about 2/3 of the way through earnings season right now. We've done a little bit north of 6 so far, not including today. I don't know how the results today have impacted the index yet, but consensus expects another 17% for the fourth quarter of 2024, and another 15% in earnings growth in 2025, while at the same time projecting that the GDP slows down. And so those two things just don't really add up. Last but not least, we talk about positioning, sentiment, behavior. They're all very similar, but we've had very strong momentum in the market up until recently. But if we look at different cohorts and how they're positioned, it's not favorable for additional upside. And we'll talk about why. And those are really more short-term kinds of indicators, but certainly helpful at the turns. And so as we talk about equities, we're on watch. This certainly doesn't mean sell all your stocks, go to cash, nothing like that. Because for the long term, investors are always going to want to have equity exposure. Markets go up over time, especially if a very long-term time horizon. Timing the market is not doable for clients, for us, for anyone. So we don't want to market time, but what we do want to do is risk manage, right? We want to be thoughtful about at the margins. Hey, maybe we take some chips off the table on equities that have run. Maybe we buy some fixed income that we've been a little bit underweight for the past few years. Or maybe we add a little bit more to our alternatives. Or if we don't have any exposure to alternatives, maybe we look to add some, right? Some diversification, things that can work well when markets are more volatile. So that's just want to level set with what we mean about putting equities on watch for downgrade. It's more so just risk managing, not market timing. So hitting on these briefly, fundamentals, we mentioned 21 times forward earnings here on the S&P 500. We look at things like growth. They are even more expensive from a sector perspective. Technology as well. Here's my arrow. Here we go. Yep, still very much expensive on technology stocks, especially. And what we're looking at here, just to level set, the green diamonds are where we are today. The bars are the ranges over the past 20 years. The blue is the average, right? The mean. And so, by and large, we are above average valuations. In some markets, we are a lot more expensive than others. Some pockets of value, things like energy still looks interesting, especially with all the geopolitical uncertainty. We still have pretty healthy weight to energy in our individual stock portfolios. And then outside of the US as well, these indexes are certainly less expensive. They've not been growing as fast, but if you're looking for relative value and opportunity, could be a place to hide out or look to allocate on any weakness. The second point we talked about were earnings expectations, right? So you look at fourth quarter up 17%, up 15 for full year 2025. We're looking at earnings on the left. Then you look at GDP estimates on the right over the same periods of time. So Jeff, I consider myself pretty strong in math. I don't know how you get 17% earnings growth when GDP is going to get cut in half, going from 2.8 down to 1.5 in 2 quarters. So it's really tough for me to feel good about the earnings expectations, what's priced in. We get excited when these expectations are low, right? When there's a much lower bar, it's easier to beat, especially when people are off sides and not invested. Whereas what we have today is a very high bar for earnings expectations, and as we'll see, fully loaded investors, right? So we call this the machine. These are all the algorithmic traders, right? Anything that has getting some alerts on Apple. Anything that has a rules-based computer program, so trend followers, volatility targeting funds, anything that doesn't have a person on the other side making the order. That's what we're looking at in blue, and they are fully loaded. You look back 2021, they were a little bit higher. We've taken out levels earlier in the year, but compare that line to the red line, which is the S&P, and you can see that these guys are certainly a major player. When the machine tops out and turns lower, the equity markets follow. When they bottom and move higher, no surprise, equity markets follow. So positioning in the systematic universe is very heavy. If we look at retail, households and investment organizations, we're looking at cash as a percentage of equity and fixed income assets. So while we've got a high nominal number in cash, if you compare that to the value of stocks and bonds, we're actually at a record low. So it doesn't, we don't really buy into the argument that there's a ton of dry powder sitting on the sidelines that can keep taking this market higher. We think most folks that are going to be invested in stocks are more or less already invested. So what do we like? We've talked about bonds. They're starting to work. You're still getting a pretty nice yield, though not quite as attractive as it was the last time we all got together. Back in May, yields have come down. We're at about 4% on the 10-year now, down from 4.5%, 4.75% back then. Still getting paid pretty nicely to wait. And now that the Fed is getting ready to cut rates, that total return opportunity with fixed income, we think is going to be really interesting. Sometimes we get asked a question, where can the 10-year go in a recession if we do get one? We think it's pretty reasonable to think that the 10-year could get down to 2.5%, 3%, maybe even 2%, depending on how bad it gets. But what we're looking at here in this table is 1-year returns of a 10-year bond based on different yield levels. So this is just the math, that relationship between the price and interest rates. Bonds have that inverse relationship. So as rates fall, bond prices go up. Now it's not going to be as great as the 20+% that we see on the chart, because at the time yields were about 5. Now they're about 4. So you need to back out roughly 7 to 8% on these numbers, but still you're looking at double-digit returns in high quality plain vanilla fixed income if we go into a recession, versus for stocks, perhaps some limit on the upside and a lot more downside if we do go into a recession. We talked about alternatives as well, just a quick snapshot of our asset allocation preferences. So as you can see, we're still neutral on equities, but within the equity space, we like defensive stocks. So things like utilities, healthcare, consumer staples, you're going to see a lot of overweights in those kinds of names in our portfolios. Underweight things like growth and cyclicals. We think it's the wrong time to own those for where we are in the cycle. We're overweight fixed income. We like core government bonds. Mortgage-backed are our favorite area of the bond market, alongside treasuries and anything that's going to be high quality. Underweight high yield, underweight leveraged loans, underweight emerging markets, anything with credit. We don't like credit. Spreads that are too tight, you're not getting compensated for that risk. Alternatives as well have been great for us. Our liquid alternative portfolio has done really well year to date. We like the setup there. Very nice diversifier. Not going to be related to the equity market. Not going to be related to the fixed income market. And then for clients who are okay with having some illiquidity, meaning that you cannot access 100% of your money on a given day, we think private credit still, it makes a really nice allocation to a broadly diversified portfolio. You can still get really high yields, lending to at the top of the cap structure to large economically resilient companies. We're looking at double-digit kind of yields in some instances that are still very high quality. The trade-off is that there are some lockups, so perhaps you can't access your money for a year. So we don't recommend that for your entire portfolio, obviously, but for folks that can stand a little bit of illiquidity, we think private credit still looks really interesting. So last but not least, we can talk about the election. Jeff, before we do that, any thing you want to add from an asset allocation perspective?
No, I think, Cliff, as you went through a lot of as we led up to the last webinar we did, right, we were looking at a little bit more risk on, or call it, we were definitely higher on that equities would continue to have some momentum, which they did. Part of that, I know I got some calls and I'd spoken and talked to clients about changes we were making in the bond portfolio as we saw the interest rates start to top out, right? And we saw that and now we think the 10-year, the 10-year went below 4 today for a little while. I'm not sure where it finished, but we're seeing that you kind of the following the process, right? We're not always going to hit the top. Our goal is not to get out at the peak. We try and get as close as possible, but the process works, right? We made those adjustments to the fixed income portfolios, and they fitted and we're looking to do the same certainty and more negative catalyst as whether it be election, whether it be just growth dropping, whether it be interest rate, an interest rate drop means that things are slowing, right? Things are not, that means the economy is starting to see some, again, those additional cracks. So we're going to, the investment team and led by yourself has definitely been right on top of it. So let's talk election, Cliff. Yeah, let's have some fun.
Everyone's favorite topic is politics, right? So look, there's a lot of uncertainty. You mentioned at the start of the call, just there's that unprecedented word again, right? We've been talking about that for the past 4 years, but having a former president and presidential candidate have an assassination attempt, I won't say it's unprecedented, but hasn't happened in the last 30, 40 plus years since Reagan. Right. You look at an incumbent who has dropped out of the race, another one that has not happened in many years. And so there's certainly a lot of uncertainty about, who is ultimately going to win the election, what their policies are going to be, what is the makeup of Congress, how does that affect our deficit, right? And so there's going to be a lot to unpack. Things are going to change. But if we look, obviously from a polling perspective, things are really tight, kind of a coin flip at this point. But what's interesting is that so far the market is following along, the typical election cycle playbook. And we showed this chart last time, but I thought it was worth highlighting again. As you can see, we've rallied, right into, end of August or, end of July into August. Typically in an election year, you get a little bit of a sell-off in the late summer, early fall going into election before rallying after the election as the market digests, what is likely to happen, what are the policy priorities. So, this would be the playbook, maybe a little bit of volatility here as we go into the election, we rally. Unless we do hit that recession. That's really what we're more worried about today is the macro and understanding the cycle rather than the election. Because if you look historically, it actually doesn't matter who wins or what the makeup of the government is. This is long-term data from our friends at Capital Group. Look at the S&P 500 on the left, whether a Democrat is in the White House or in blue, or whether a Republican is in the White House in red. Over the long term, markets go up, right? Regardless of who is in power. And actually the numbers, I don't have the specifics, but the average returns are pretty much neck and neck, regardless of whether it's a Republican or a Democrat. Same thing when you look at the makeup of Congress and the White House, right? Whether you're in a unified government, you've got the best expected return at 14.4 on average, going back to 1933. But even in a split Congress or a period where you've got unified Congress and an opposing president, still have averaged double-digit returns in equities over a long period of time. And so, most importantly for our clients as we think about the election is that, yes, there's a lot of uncertainty. Yes, this is, one of the more important elections in recent memory, as they all are. But when you zoom out over the long term, ultimately elections historically do not have a major impact on long-term equity market returns. We think that pattern is likely to continue. Short term, absolutely, there will be things that change, but our economy is dynamic. Our markets are efficient, so we will and can and do adjust to whatever the new normal is going to be. So, just quick public service announcement that yes, we are watching the elections. Yes, they are important over shorter term time horizons, but over the long term, it's much more important to think about where you are in your financial plan, along the path of retirement, what your goals, what your needs are, your overall risk tolerance that you're taking on is much more important than whether the Republican or a Democrat takes the Senate and the White House. So just wanted to hit on that briefly, Jeff. And if we have questions about elections and policy, happy to go into any details on that. But just to close, as we think about what are the implications for our portfolios and for our clients, first and foremost, we're on watch for an equity market downgrade. Again, doesn't mean sell stocks, run for the hills. But if there are opportunities to take profits, add to your fixed income, add to alternatives, we're going to be doing that most likely here over the coming weeks as we get more data. Within equities, we want to focus on high quality. We want to focus on relative value, not chasing the high flyers, not getting caught up in the euphoria, but being a little bit more detached from the day to day. Fixed income and alternatives, we really like both of those asset classes. In fixed income, we want to overweight duration risk. We want to overweight interest risk in favor of credit. We don't like credit, so high quality. We want our bonds to play defense and produce some income, and then supplement that core holding with some income producing exposures. Same thing in alternatives. We love the diversification benefits of alternatives, especially if we get volatility in the equity markets. And then for those investors who are okay with having some illiquidity in your portfolio, we think private credit is still one of the better opportunities on the board in the alt space. So Jeff, before I turn it back over to you, just want to take a moment to say thank you to everyone for the time today, for joining us, for giving us the opportunity to come and work for you each and every day. We take that responsibility very seriously. Our investment team has been very active in the background, and we look forward to continuing to position our clients and their portfolios for whatever environment may come, whether it be a recession, an election, what have you. We will continue to follow our process. Jeff, I know you love the 3 Ps. So just want to close there and send it back to you.
No, thanks, Cliff. Again, a lot of great information as always, and just everything you went over. Right, we're entering that time of year that August, September, October tend to be the more negative months in the markets, or have been historically. Again, as a student of history, as you put it, right? October, the more volatile. August and September have it more negative, right? More negativity or more downside in the stock market itself. We're there, right? So we're going to continue to watch the data. When you talk about the election, right? We work in the nose. We know that no matter who is, if it's if it's Trump or if it's President Harris, we know the tax law changes are set to expire on 12/31 of 2025. Likelihood of making a change is probably unlikely, but we operate in the know. So we know taxes are set to go up no matter who is set to be in, unless something major changes. The estate tax laws, right? We know what's out there. So we've talked about it as advisors. We've talked about it with our clients. So again, understanding what everything that's available and what we'll discuss. Cliff, we did have a couple questions. So before I wrap, one came in regarding when we were discussing the fixed income. One question was about the municipal bond market, and municipal bonds, again, for everybody, is just tax-free bonds. Definitely beneficial for many, but not for all. If you're in a higher tax bracket, the highest tax rate, the most, because it's the tax equivalent yield that you're getting a lower return, but because you're paying taxes on money. So just want to know, kind of where you stand, Cliff, neutral, positive, negative. What was your standing on in the fixed income market where municipal bonds would fit?
Yeah, and that's a great call out, Jeff, and you nailed it. For folks that have after-tax money and you're in a high tax bracket, munis would fit right in this core bond portion of the chart. I'll get it added for the next round. But yeah, we really like those. We'd be overweight munis relative. Much like agency mortgage backed, as long as they're not, as long as you're not taking on credit risk. So, we manage some municipal bond portfolios internally. We work with some partners as well for individual bonds. Those are all going to be high quality. We like those, not as high on high yield munis.
So, Cliff, another question that we had that had come in was about you were talking about recession, right? Whether we're able to see that soft landing. But so one of the question was what data would you like to see to give more confidence the recession could be avoided?
Yeah, that's certainly not a foregone conclusion that we do go into recession. We think about the world in terms of probabilities, risk, and return. And so, certainly it's not a certainty, right? Things we would like to see: job openings turning back higher. We've seen just the openings, the rate of openings coming down. We'd love to see those inflect back higher. We'd like to see hiring increase. Hiring has fallen, pretty dramatically. We just have yet to see layoffs. So if we were to start to see hiring turning back higher, that would be great. We'd love to see profits accelerate. The earnings expectations get met and beat. That would be fantastic. And then I think last but not least, China has had some pretty severe economic problems, especially with their property and real estate markets. The Chinese authorities have really not aggressively ramped stimulus like they have in the past. If they were to get more aggressive on stimulus side out of China, that would certainly get our attention, especially if we saw commodity prices start to move back higher. So those would be some examples of things we're looking for.
Yeah, Cliff, as we were talking today as well, Intel announced they're looking to reduce headcount by about 15%, right? So the tech companies, when we talk about the labor market, right, it's cracking, right? They're starting to see more and more cracks come along. So I think one last question, Cliff, we'll stay on the recession topic. So question was, if we do get a recession, what does that look like?
Yeah. So certainly, our view right now, if we do go into a recession, that it's likely going to be shallow. Think more 2001 rather than 2008. There's certainly not as much leverage in the system, specifically for households or for corporations. Now, all the leverage or all the debt more or less relies on government balance sheets. We certainly have more levers at our disposal, being the global reserve currency of the U.S. dollar to be able to manage that. But by and large, people are not stretched. If that were to happen, if we do go into recession, the unemployment rate probably goes up to 6.5%, up from 4%. We think that is good enough for the Fed to take interest rates down to kind of the 2.5. Maybe we're at 2.5 to 3 on the 10-year. Mortgage rates probably fall back to the 4s, right? That would support housing. That would help us work through that recession, especially if the housing market can get going again. Where I think the risk is in the equity markets, right? Just with where we are from a valuation perspective, the concentration that we have, especially in these Mag 7 stocks in the S&P, we could see 20 to 25% at the index level because of that concentration. But there are going to be pockets of a lot of stocks that could do pretty well, right? The ones that are not that expensive. And so it'll be really more about the average stock doing okay, and the ones that are highly concentrated and where we're seeing the euphoria, those are where the risk would lie.
Well, thanks, Cliff. And thank you everyone for your attention, your participation. We as always, we've covered a lot of ground. We talked the growth, we've talked inflation, spent some time corporate earnings, election, geopolitical. Again, understanding the dynamics of all of these is essential as we navigate, the complexities of the market. The 3 Ps, process, planning, and patience, remain paramount with wealth management, but as well as with our investment management team. So it's always in times of when volatility, staying informed, adaptable is going to be the key. We shared some insights, and not just about the numbers, the trends that we're following, things we look out for our investment process, how we can strategically position ourselves for the future. Again, we're not looking for minute by minute, day by day. It's, again, this is the long term. But whether it be through diversification, staying on top of the technological advances, we're doing so. We're being mindful of the global events. our goal is to make those well-informed decisions that align with you, our clients, and our clients' financial goals. So again, we thank you. As I mentioned, we'll have an email out in the next day or so with the replay. It will be posted on our YouTube, our social media sites. Feel free to share those. Again, as we move forward, it's the resilience, innovation, and the forward thinking that we take as an investment team, as a wealth management team, to make those informed decisions for you. So thank you again. We appreciate you all listening. Have a great rest of your summer. Stay cool. It's hot out there, but we enjoy seeing you, enjoying spending our time with you. Thanks, everyone.